All right, should be good there too. Good afternoon, everybody. Happy Thursday, September 4th. I'm an associate member of T3 Trading Group, which is an SEC broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure, I got back into Alibaba and I shorted WDC and STX that I'm keeping as a swing. Oh, and I have a little bit of IWM short, like a very little bit actually. Let me add that on there too. All right. So that's the position disclosure there. But I see not too huge positions in WDC and STX, just kind of on day 3 up, looking for a little daily chart retracement on them. Obviously, those are going to move based on AVGO, which we're still waiting on, or potentially they could move a little bit on AVGO. So position's not too big, but the extension is pretty big. And then we got non-farm payrolls tomorrow. All right, let us jump in and have a look at the price action today. I got to tell you, I am very surprised, as I think a lot of participants are, just by the degree of strength today. I really am. The SPY finished up 0.9%. The Qs finished up a percentage point. The IWM finished up 1.25%, so relative strength from the Russell, pretty impressive relative strength. TLT's up 0.75%. I keep talking about it. A lot of the concerns out there are on bonds falling off a cliff, and that is not what is happening here. This TLT is range bound. It's holding in great. Honestly, the TLT technically to me looks like it could break higher, which I feel like no one's talking about that at all. Uh, and the dollar still is in the same range that it's been in also. This UPTF can't seem to hold above that 2750 and accelerate, but that's something that we also need to pay attention to. Excuse me. Bitcoin down 2% on the day. So kind of your digital gold, maybe Ethereum, which is interesting because I'm starting to feel like Ethereum and some of the other coins that are not Bitcoin are a little more indication of risk on, risk off. Ethereum down a lot today, down 4.5% or 4% plus, and that's with the market up huge. So it's interesting. Gold was down a little bit, but it's a much needed little retracement and rest on gold. It was starting to get pretty extended after yesterday, and oil was down as well. So again, circling back to the index level, I am really surprised at the degree of upside strength. AVGO is out. AVGO initially trading down, and now back up. Now green, going up $4 or $5 here. Broadcom third quarter semiconductor solutions revenue is a small beat. So third quarter revenue is a small beat. Third quarter adjusted EPS is a small beat, 2-cent beat. AI semiconductor revenue is a large beat, 6.2 billion. Oh, that's guidance. That's a good guide. Broadcom sees fourth quarter AI semiconductor revenue at 6.2 billion versus estimates of 5.82 billion. And Broadcom sees adjusted third quarter. Broadcom, this is looking back, adjusted third quarter net revenue was a beat by 0.1%. It's the guidance. That's a good rev guide, I think. 6.2 billion versus estimates of 5.82 billion. I think that this is maybe the best semiconductor earnings report we've seen this earnings season compared to like expectations and the whisper number. So Broadcom here initially trading up $5, $4 now. See if it holds on to those gains. Yeah, chart looks great also. Up the AVGO daily. So let's see if it holds those gains. But that's a pretty good report. We have seen every single semiconductor sell off on their earnings report, though, despite how good they've come in. Let's see if AVGO is the one to change that. I kind of predicted, but it's always a guess, into the close that AVG up would go up on their report. I feel like people forget about this one, even though it's the Mag 8. It's like the 8th company if you had a Mag 8. As I say that, it's selling down here again a little bit, so it's only up $2, $3. That's a pretty decent revenue guide compared to expectations, though. I would expect this to be higher. And now it's back to flat. What is Nvidia moving on this? Nvidia's down 5 cents. True, 40x sales. They're all expensive. AVGO going red here again. All right, we'll see how this thing settles out. Initial tick was down, then it was green by $8-9. Now it's down very, very small. So a little bit all over the place. 25x sales seems a little bit more reasonable than 40x. So yeah, we'll keep an eye on this. We'll keep an eye on this Avago. It's not called Avago because the symbol is AVGO. Broadcom merged with or bought out. I don't really remember Broadcom and Avago, and I don't know how many years ago that was. People who don't understand why Broadcom would have the symbol AVGO, that's why there was another company called Avago that they merged with, and because the symbol is still the Avago symbol, I call it that at least as often as I call it Broadcom. All right, so that's our important company here, trading very flat. The Nasdaq looks like it's continuing to trade up after hours, though. So why not? Nasdaq and S&P are both continuing to trade higher. That's despite Lulu also getting smoked here after hours. I don't know how important Lulu is, and AVGO doing nothing after hours. So those are the two most major earnings reports that I'm aware of for after the close today. And they're not impressive, but going back to what I was saying about the market when I was trying to kick off the afternoon meeting, the market is impressive. Is it a new all-time high close for the SPYs? 649.12? What was the last one? 648.92. It's a new all-time high. Wow. Wow. Um, so anyway, as I was starting to say, I don't think anybody was expecting a big move today. I certainly was not. This is the Thursday in front of non-farm payrolls. Tomorrow is supposed to be the big day. Tomorrow is the day everybody's been waiting for, where we are going to have a look at the August non-farm payrolls report. One of the most important economic numbers right now because all are watching jobs in the United States to see if it accelerates the worsening conditioning of the job market continues to accelerate and continues to get worse. It's what everybody's paying attention to right now. But as we talked about in the morning meeting, and I can bring up that JP Morgan note again, we are in a weird environment right now. The way that news impacts the stock market is something that's constantly evolving, and it's not, to anyone who's maybe a brand new trader, it's not straightforward, right? It's not as simple as, oh, the economy is improving, so the stock market goes higher. Oh, the economy is getting a little bit worse, so the stock market's going lower. It's not that way, right? Because it's how the economy is moving compared to expectations, but also what it may mean for the future. So, for example, we're in an environment right now where if the economy is getting a little bit worse, like it's deteriorating a little bit, that's actually bullish for the stock market. Um, why? Because it means that we're going to get interest rate cuts from the Fed, so the Fed can begin to stimulate the economy further. So in the Fed we trust. Don't fight the Fed. A economy that's doing a little bit better than expected, that's improving a little bit, that's also bullish for stocks because, well, the economy is getting better, and we'll probably still cut interest rates. What could be a negative for the stock market right now is basically a big beat or a big miss. Like if the non-farm payrolls number is great tomorrow, that actually could be bearish because then maybe we're going to have less cuts because the economy is doing really well, especially if you're seeing inflation continuing to rise. Really, really bad number tomorrow will also be really bad for the stock market because, well, the economy is deteriorating so much so fast that the Fed is behind the curve, or the other argument you could make is that the Fed is handcuffed because the economy is rapidly deteriorating while prices are also increasing. So what that leads to, if we circle back to Pat's morning note this morning, which had this J.P. Morgan non-farm payroll scenario analysis that we've been making jokes about all day, is the JP Morgan non-farm payroll scenario analysis basically says we're going up no matter what. Like 90 to 95% chance of us going up. 40% chance that it's roughly in line and we go up half a percent to a percent. 25% chance that it's above expectations and we go up half a percent to a percent and a quarter. 25% chance that it is slightly light compared to expectations, but like I said, slightly bad is good, and we only go up 25 basis points to 50 basis points. And then the lower probability extreme scenarios can lead to a potential larger sell off. But I always thought that this was the craziest one. Above 110,000, so a really good non-farm payrolls number. They're predicting that the S&P could gain up to a percent or lose up to a percent and a half. In other words, they have no idea what to do if the non-farm payrolls number comes in excellent tomorrow, which is hysterical. So it's like 90% chance that we're going up, 5% chance I've got absolutely no idea, and 5% chance we go down. That's what JP Morgan is telling us. It seems a little bit silly. That's why we've been making jokes all day. In some ways, it is a little bit silly, but it also, again, it makes sense given the environment that I kind of just described and where we're at. So we'll see how that plays out. I would also just note that these last several like CPIs and non-farm payrolls, when we get the preview from JP Morgan, JP Morgan has not been super accurate with these. uh, there was a couple numbers that come to mind immediately to me where whatever JP Morgan predicted that we should have been up based on the numbers, we were up, but not nearly as much as JP Morgan had predicted. So this by no means a guarantee that if you see whatever this non-farm payrolls number is, that you're therefore going to get the range that JP Morgan is predicting. But it's still a good proxy to look at in front of the number. I actually prefer what Goldman puts out, but I haven't seen anything from Goldman yet. So circling back to today, the non-farm payrolls number is tomorrow. This is the big event that we've been waiting for all week. I think a lot of folks out there, myself included, were not expecting that we would get anywhere near as big of a move as we got to the upside today. I was very wrong, and it cost me some money. I'm down a nice chunk of P&L today. I'm always pretty honest about that stuff. So my swings went against me. My day trades that I put on today were primarily like a little bit bigger picture day trades with the WDC and STX. But I'm down money on both of them into the close. Lost a little bit of money trading the indexes today as well on the short side. I just couldn't nail it. I thought we were gonna have a roll down into the close because a very common pattern that we've seen a lot, especially on days where you're expecting it to be more rangy, is that if you're grinding higher, you roll down in the last 30 minutes to an hour, just profit taking on the buy algorithm that was there all day. We didn't get that either. We actually got an acceleration to the upside into the close. So I was very wrong today. I lost some money because I was wrong. It just is what it is. It's part of the business. But also, if you looked at like the straddle today, it was not expecting a big move. We also had like the Iron Condor mystery guy put on a decently sized position and took the maximum loss on his Iron Condor. Most of the time, that guy makes money. Once in a while, he does not. He's even bigger for tomorrow, though, which is interesting. He's got a huge Iron Condor on. What do we see? 45,000 options contracts on that Iron Condor for tomorrow. Just a huge amount on the SPX into the non-farm payroll day. So that's a hell of a bet. So I'll be curious to see just scientifically how that plays out for him. I feel like whenever he gets this big, he almost always makes money. I don't know, Bill K, if you can remember a time where he's gotten that big where he's lost money. I think it might have happened once, and then he still martingaled it and doubled up again. Um, but yeah, I mean that's interesting too. But it just goes to show you, I think that there was a lot of he has not lost at this size. Okay, he has not lost at this size. Wow. So that just goes to show you. I think that there was a lot of smart money thinking that we were going to have a range bound day today, and no losses over 40K, 50K for tomorrow. And we did not. We really squeezed to the upside to new all-time highs in the SPYs. It was primarily led by the IWM, but it was pretty broad-based. The Qs participated also. Semiconductors participated. SMH was up pretty good. Nvidia was a little bit relatively weak today. Palantir was a little bit relatively weak for most of the day today. But that's pretty much it. Just contrary to my expectations, a pretty big upside trading session today for the spies. It's based on how I like to judge technicals when we do the bull bear neutral game that I always like to do. We had been in neutral territory yesterday. We were in neutral territory at the open. Technically, we are, in my opinion, back into full on bull mode. Spies. The daily chart is bullish. Qs. The daily chart is bullish. They got back above the high from last Friday. Alibaba's scare day. And the IWM here very clearly, very obviously is full on bullish. From my experience, if there's ever something that can change the technicals rapidly, change the technical picture rapidly, it's a fundamental event. So we do have a fundamental event with the non-farm payrolls tomorrow, but just because it is an event that could change the technical picture definitely does not mean that it has to. If anything, it's probably more likely that it doesn't. But all eyes are on non-farm payrolls. We've got it at 8:30 tomorrow, and we'll see how it plays out. But otherwise, these technicals are full on bullish, and they're not even that extended. So you can still be looking for long trades, but at this point, I probably would wait to see where the dust settles after 8:30. So that's pretty much all I got. Again, lost some money today just by expecting us to have a range day, trying to position myself for range bound moves and getting caught and squeezed into the uptrend, and it just is what it is. And we'll see where the dust settles tomorrow. I don't really have anything else to talk about, so I'm happy to answer any questions that anybody has. Yeah, so we got Lulu smoked. I didn't look at the report. If you guys want, I could take a quick look at it. Lulu gross margins beat, second quarter EPS beat, second quarter net revenue basically in line. Here's the guidance. Third quarter net revenue guidance is a miss by 0.06 to 0.08 billion. Lulu third quarter EPS. That's a big miss on the expected third quarter EPS. 2.18, $2.18, $2.23 versus estimates of $2.90. That's a big miss on the EPS guide for Lulu. And it's down to 180 with no support anywhere in sight. You got to go back to COVID. I don't really look at Lulu that often. I don't trade it that often. But you got to go back to COVID to find the last time it was trading down at these prices. So not going great. Not going great. All right, what else? Varun letting me know that the cash SPX all-time high is slightly higher. Okay. Rock saying we already saw CRM, COP, Google, and Microsoft lay people off. Yeah. 3 of the 4 companies you mentioned are tech companies. I feel like sometimes because we're so focused on tech, we see the layoffs coming into tech and we think it can go into the broader economy, and it never seems to be that way. But if you saw ConocoPhillips doing layoffs, I didn't see that. That's interesting. Very, very different type of business, obviously. So we'll see. But again, a small deterioration in non-farm payrolls probably means higher prices tomorrow. That was a comment from Rock. What else here? Varun, Amazon, Netflix, Meta, Google, Apple. I don't even know what you're asking me, sir. I could take a quick look at those names though. Amazon, I love. We called out the long in Amazon this morning versus 230. You had to pay up a decent amount, so I don't know if anybody took it. It was just based on the pre-market daily charts. Amazon had some good news this morning, a good report circulating around it. 230 has been an important level. Amazon looks great. Netflix also looks great after today. Broke out above some resistance, trying to break its range to the upside along with the market. Meta, that's a weak close in Meta. I didn't see that. Uh, they ripped it off the open. So Meta also had some headlines circulating this morning, which I honestly don't remember what it was. They ripped it off the open, but this didn't close well considering that opening strength. I don't love that upside tail into 760. Google, I continue to be a huge fan of. There's nothing for me to do in Google at this price if I'm not already in it. Apple is pretty much the same deal. Microsoft's, I don't like that Microsoft chart. If it gets above 510, 512, it'll look better. Tesla's been really sloppy. It was a little bit weak at certain points today. And Nvidia, I still think Nvidia looks like crash on the daily, but it's a little bit been digesting some downside extension. So I'm still in wait and see mode on that Nvidia to try to push it further. I want to relook at it tomorrow. I usually do my research in the mornings. I want to look at this Nvidia again tomorrow morning. This could be something that you could try to short through 170 on a NFP downtick if it were to happen. So it may be something to be prepared for mentally because tomorrow that ADMA on the daily will continue to move lower, catching up to kind of this bearish consolidation that it's been doing for 3 days, some relative weakness today. We'll see how AVGO settles out as well, obviously. But which according to JP Morgan, there's a 90% chance plus that we will not be going down. But if we were to trade down as immediate reaction in NFP, you might be able to short Nvidia through 170. I kind of like the trade. From Tanner, what type of order do you use to get the best fills in the first minute off the open? Um, the way that I trade is primarily through limit orders, even if I'm taking liquidity. So most of the time I'm providing liquidity, but sometimes I take liquidity and I'll cross limit orders, or I also will use actually a lot of times if I just need to get in a position right away at the open, I'm using what I call an uptick or a downtick key, which takes liquidity, but it's not a market buy or a market sell. A market buy or a market sell will get you in or out at any price. An uptick or a downtick will get you in or out by taking liquidity, but only through a certain price. So if there's a wide spread or not a lot of liquidity, I'm not going to get a terrible price. I'll either get what I can get or not. So like if the inside offer is $21.10 and my uptick key is set through 3 cents and I try to buy 3,000 shares, it'll get me I'll take the liquidity that's at 21.10, 21.11, 21.12 and I think that's it. That's 3 cents. And if that liquidity over the course of those 3 cents is 2,200 shares, then I get filled 2,200 shares of the 3,000 share order I tried to buy. And that's it. I don't get the other 800. And I can assess if I want to pay out further on the other 800 or not after I see that I only got a partial fill based on the liquidity that was there. So a lot of times, if it's taking liquidity, then uptick, downtick. Otherwise, I'm placing bids and offers to provide liquidity at the prices that I want, which is what I prefer to do most of the time, except for possibly when I am entering a new position for the first time. That's when I will take liquidity a lot more often. Like when I did initially enter STX and WDC short, I started with downticks, downtick, downtick, and then I offered out to add part of the game plan I established. So hope that helps, Tanner. From Ryan, the twos and tens are breaking below recent lows since May today. I don't know why, but it seems like a signal to me. Any thoughts? After SPY at all-time highs, folks seem to be front running the easing. Yeah, that's what I think is happening also. That's exactly what I think is happening. I think that they're front running the easing, and I think that they're doing it at a time when there are all these fears between the UK and Japan, and then to some degree, but to a slightly lesser extent, the US, that regardless of basically the Fed um, cutting, that rates, especially on the long end, would continue to move up. And I'm not seeing that happen. So Yeah, I agree, Ryan. That seems to me what I'm seeing also. With that said, what I saw at I think pre-market this morning is that the Fed is cutting it is that the market is pricing in a 95% chance of a 25 basis point cut at this point. So I don't know how much front running there is left to do. So we'll see. For what it's worth, I'm pretty sure someone should fact check me on this because I haven't researched in a long time that the first one or two rate cuts in an easing cycle usually are combined with a market that continues to move down, not up, contrary to what people think when they think of the beginning of an easing cycle. But obviously, every circumstance is unique, and you could make an argument that the cut cycle actually started at the end of 2024 and it's only continuing here. I probably would not argue that. I feel like these are separate cuts. Those cuts were more maintenance cuts at the end of 2024. Inflation had come down from 9.1% to 2 point, I think 6%. So they were um, lowering, the Fed was lowering rates to keep the the real level more steady, whereas these upcoming cuts seem to have more to do with economic deterioration and as seen through the labor market than anything else. So it's different. Um, Yeah, and so Ryan here with a follow up that I think is really smart. That's my thoughts too. It seems priced in. Could we get a weaker number than expected tomorrow and more cuts than expected? I don't know, just reaching here. Oh, so there's that possibility. I actually thought you were saying the opposite, which is more my thought process that maybe they're starting to overly price this in. Like again, going back to that JP Morgan note where 90% probability in every scenario that we move higher tomorrow on this number, um, like that is overly priced in, and maybe we could actually trade down on it, and they front run some of that today. That's more of where my head's at, actually. Uh, you seem to be if like the number is weak tomorrow on the thought process that maybe we could reach towards like a 50 basis point cut in September. I don't think that. I almost think that no matter what happens tomorrow, unless we get like an absolutely and utterly abysmal NFP tomorrow, I don't think we're getting 50 basis point cuts because there's still too much uncertainty on the inflation side. So they'll do the 25 basis point cut. Maybe the dot plot could price in more 2026 cuts, but I don't know. It seems like a really strong move today if that's what's happening. We're dot plotting in more 2026 cuts when that dot plot, when you go out that far, is fairly unreliable because things change a lot over the course of between September 2025 and where the dot plot might say for September 2026. So tomorrow's going to be an interesting one for sure, especially after today. From Jerry, despite the JP Morgan note in non-farm payrolls, would there not be potential for a flat day or a lower due to three big days in a row into resistance? I love the technical thought process. That's the first thing I would say. I would want to see more upside extension to feel confident for that thought process. If we had $10 of extension in the SPYs tomorrow, I would think, despite what JP Morgan is saying, that the risk is to the downside. So yeah, we have three up days. I don't know. Do we even want to count Tuesday as an up day? It's up compared to where we opened, but it was still a negative trading session. Yesterday was green, today is green. I don't think it's enough. I know there's resistance. We're pretty much at all-time high resistance here for the SPYs. But I don't know if it's enough from an extension perspective, if they front run it enough for me to think that the risk is really to the downside tomorrow. I don't think that the risk is as much to the upside as the JP Morgan note would lead you to believe. I can definitely say that. I don't think there's a personally, if you're asking me, I don't think that there's a 90% chance that we're moving higher by what JP Morgan says in every scenario, especially after today. Um, so I think that there's more risk to the downside than that note says, but I don't know. We gotta see what the number happens, see what the reaction actually is. I don't think that the risk is to the downside though, for sure. I think it's just a little, I think it's more neutral, I guess is what I'm trying to say. More neutral than the thought process I would have if we were very extended higher. More neutral than the thought process that JP Morgan's providing as well. From Zahor, can you go over the MOC imbalance that Pat reports towards the end of the day? How do you interpret that as far as preparing for the end of the day volatility and taking any positions on indexes, ETFs, or single names if appropriate? So, um, there's not really a trade there for us anymore. It's just information. I say that with a big asterisk because I do know some traders, actually, some at T3 who are extremely successful, and they are MOC traders. But even for those guys, they basically are just doing the Russell Shuffle, and monthly OPEX, quarterly OPEX is where their entire edge is, where you get the much larger MOC imbalances. But basically, if you don't know what an MOC is, I can give a brief overview on it. There's a type of order that exists called market on close. There's also a type of order called market on open that is basically designed to give you the opening price of the day or the closing price of the day. Why people need that price could vary for a whole ton of reasons. Maybe you're running a mutual fund and you need to rebalance at the end of a day or whatever, and you need to actually have the closing price for that for your fund. That's what you need. That's what your prospectus says or whatever. So there's a whole bunch of reasons why people might want to have their execution price be the closing price. But basically, you can put in a market on close buy if you want to buy the closing price. You can put in a market on close sell if you want to sell the closing price. If you put in 1,000 share, if I put in a 2,000 share market on close buy, and you put in 1,000 share market on close sell, there's an imbalance. There's 1,000 share buy imbalance there. So the market works with supply and demand. So what you tend to see, and this is not a 100% truism, what you tend to see is that if there is an MOC buy imbalance, then the market for that market or stock will move higher to a price that is high enough where the supply and demand then evens out to satisfy that buy imbalance. So if you see a very large buy imbalance at 850, a lot of times you see the market whip higher. If you see a very large sell imbalance, a lot of times you see the market whip lower. For us, again, to repeat what I said in the beginning, that's primarily just information. It's not tradable. There are algorithms that have been designed. I know guys that run these algorithms that make decisions faster and absorb information faster than the human eye can blink, that are pretty much instantly arbitraging away the MOC. The MOC hits and it is instantly going higher or lower. They're buying it higher or lower faster than you and I can digest that information and act on it. The exceptions are when the MOC is so big that you don't even need to be first to make money because the market needs to move by that large of a degree. When does that usually happen? Well, that circles back to when the few hand traders I know who actually still trade MOCs and make money from it, when they execute on Russell Shuffle and monthly OPEX and quad OPEX, because that is when you get the really big, sometimes MOCs for individual stocks. But it's not I don't have an edge there. I've I occasionally mess around a little bit with it. And I was getting, which I might getting in soon. I'm not sure. I'm in talks with this group that's on the floor of the New York Stock Exchange. If you guys remember, there was a time where I was getting like a trial of early look MOCs starting at 2 p.m. Eastern, updating every 2.5 minutes that were potentially tradable to front run the MOC. So I'm still in talks with them about onboarding some routing to them to then actually maybe be able to distribute some of that information out to you guys so that some of you guys can work on finding an edge. I'm not sure what time on the market on open. I've never done nearly as much with market on open stuff as market on close, and I never found the market on open stuff to be nearly as market moving as the market on close until very recently. Very recently, I don't know, last year or so. It seems like, and I don't ever remember this being the case, at 9:25 a.m., and it's disruptive of the morning meeting because the morning meeting sometimes we're still finishing it up. we're seeing MOOs hit um, that are moving the market and moving my stocks. I'm getting filled on stocks, so I'm trying to wrap up the morning meeting, which is tricky. But I don't have as much experience on the MOO stuff as I do on the MOC stuff, so I don't really know. I don't know what time you can start to put the orders in. Uh, Tracking, trading, and working out so far. Okay, well, if it's working for you, you know my motto. If you have an edge that works for you, even if it's not my edge, it's an edge, and there's no wrong way to make money as long as it's making money consistently. Today was a big MOC. You could have made money, obviously, when the MOC had by buying the market, but I think that's unusual. From Scotty, looking back to January, February of this year, in the Qs and the SPYs, we had something similar with all-time highs and the pullback consolidation. What's different this time? The biggest thing that's different this time is hedge fund exposure. That's the biggest thing that's different to me. Um, the technicals in February looked beautiful here. We knew that, but I was shorting the hell out of the market into that all-time high because of the flow of funds data that we get that basically indicated there was no one left to buy and everyone was available to sell into a down move. And then we got the catalyst for the down move. That's different now. And I meant to mention this when I was kind of reviewing. I don't have a ton of time today. I have to be uptown by 6. So I gotta not do too long of a meeting here. But one of the things that surprised me about this move that I didn't get into before, and now I'm going on a tangent, was that the gamma level is so high. The gamma level works in both directions. So into a 1% up move today, we should be seeing $10 billion worth of selling. And also the vol control were sellers on the way up. I don't remember to what amount. Bill K provided the information in the pre-market, but if you had definitely a percentage or more on the upside, you were running into big selling from vol control, probably even some selling even at 0.5% up. So I figured between the iron condor, the fact that it's the day before non-farm payrolls, the fact that vol control would sell into an up move, the fact that gamma would sell into an up move, I really thought that it was a very low, very, very low probability that we were going to get the up move that we had today. But it still happened because low probability moves happen. But the difference between February and now is the hedge fund exposure is not very long. Systematics are fully long. We had that in February as well. But the long short community is not. Hedge funds are not. They're not very long at all. If anything, they're underexposed to the long side, and they have a lot of short exposure. So in my head, as we come into September, that is less upside risk and more downside cushioning. So that's why I have been of the opinion, especially for the first half of September, big picture, that this market would be more sideways chop or grind lower as opposed to acceleration lower. Because unlike February, where we got acceleration lower after Feb OPEX, you've got hedge funds that will be buying the dip and covering shorts in the dip, and you did not have that then. That's the big difference. So we're not, from a flow of funds perspective, as bearish here in September, even as we're getting into the seasonal weakness, as we were in February. So that's what I think is the big difference. And again, I don't want to overread what you just said about the all-time highs pullback consolidation. We just closed at all-time highs today. So the technicals of this market are bullish. It's very straightforward. They are bullish, and that has to be respected. You don't want to predict that bullish technicals are all of a sudden going to fail for no reason. We felt in February we had a reason. And I feel in September we have a reason to not be super bullish despite the technicals being super bullish. I don't think we have a reason necessarily to be super bearish at this point. That could change very quickly on the wrong economic number. And that could also, I think, can deteriorate further when we get to September OPEX. September OPEX is when I would expect that we could accelerate lower, right? I said the first half of September, my general expectation is sideways chop to grind lower. So I'm wrong so far. But then I think that that could lead to acceleration lower in the back half of September. But whenever you're talking about big picture predictions like that, you always got to take it day by day and be willing to update your thought process as the new evidence presents itself day by day. And you have to respect the fact that the spies and Qs after today just went from being technically neutral to technically bullish. And that's simply that. The trend is your friend. The technicals are number one. Price pays, price tells you what to do. Uh, it could change very quickly tomorrow or not. So we'll see. Cool. Rant giving you an answer there, John. I hope that helps. Quick look at the YouTube because then I've got to wrap things up. From Steven, general trading question. How do you recommend your students manage positions when on vacation? I recommend that they close their positions out and go on vacation and enjoy it. Do as I say, not as I do, because I never ever personally do that. I try to reduce exposure as much as I can, but I end up trading on vacation and bringing a laptop to places during the week and being stressed on my vacation during the week. Do as I say, not as I do on that one is what I recommend. From Plasma Lab, it will take time to get real job numbers again. Okay. Not really sure what the comment means, but I'm in a little bit of a rush. From Giancarlo, what's your thought process and price target with your short positions? I'm not in MSTR. I've been kicking myself. I've been saying this every day that I'm kicking myself that I'm not for an MSTR. I would like to be. There's been plenty of setups and pullouts on the way down here that the team has had to be short. Nice little downside tail in it today with the market help. But this MSTR to me, eyeballing the technicals, looks like it's going to 280. Just as technical continuation of this break lower on this trend pattern. From Apex Joy, how market continue bullish run without AI semis? It's a great question. It might still be in a trading range. I mean, rotation is the name of this game. I think that you need to see correlations increase, and correlations increase, and they increase on the upside because semiconductors did participate today. But for the most part, you're right. The leader for most of this rally has been AI and semiconductors. That has stalled, but it's just rotated to everything else. It's rotated to the IWM, to mid caps, small caps, to the companies actually that should benefit most from a Fed cut. Small caps, mid caps, IWM value. So that's right now. We're not seeing correlations increase. We're not seeing a VIX spike. That's kind of what you need to see correlations increase on the way down is for the VIX to move higher. The VIX can't get out of its own way. Every time we get a gap up, it sells off within a day or two. So you need the VIX to move higher and hold higher. Correlations to increase to create a down move. You probably require an event for that to happen. So great question. Spies close at all-time highs. SPX might be just below all-time highs. Formula One. All right, I'm out of time, guys. I gotta jump. I gotta be somewhere. So apologies for that. But I think we had a pretty good afternoon meeting with some good questions, and all signs point for tomorrow. Have a great